We're dissecting a monumental development that has sent ripples across financial markets worldwide. Signed into law by President Trump on Friday, July 18, 2025, this legislation primarily establishes a comprehensive federal regulatory framework for payment stablecoins. For those unfamiliar, stablecoins are a type of cryptocurrency designed to maintain a stable value, typically by being pegged 1:1 to a fiat currency like the US dollar. Think of them as digitized dollars, aiming to combine the speed and efficiency of crypto with the stability of traditional assets. This is perhaps the most critical aspect. The Genius Act mandates that all payment stablecoin insurers must maintain full 1:1 backing of all outstanding stablecoins with high-quality liquid assets. This includes US dollars, demand deposits at insured depository institutions, short-term US Treasury obligations, and balances held at the Federal Reserve. This provision directly addresses a major concern in the crypto space: the lack of transparency and solvency issues that have plagued some stablecoins in the past. It aims to prevent a repeat of events like the Terra Luna collapse by ensuring that every digital dollar issued is genuinely backed by a physical dollar or its equivalent. Now, issuers are now required to hold these reserve assets in segregated accounts and undergo regular, independent third-party audits. Furthermore, they must provide monthly public disclosures of the composition of their reserves. This level of transparency is unprecedented in the crypto world and is designed to build significant consumer trust and confidence. The Act explicitly brings stablecoin issuers under the purview of existing Bank Secrecy Act requirements. This means they must implement robust AML and countering the financing of terrorism programs and comply with Office of Foreign Assets Control (OFAC) sanctions. This is a crucial step in legitimizing stablecoins within the traditional financial system and combating illicit activities. The Genius Act prohibits issuers from paying any interest or yield on stablecoins. This is a notable distinction from traditional banking, where deposits often accrue interest, and aims to further delineate stablecoins as a payment mechanism rather than an investment vehicle in and of themselves. The legislation explicitly prohibits algorithmic stablecoins from being classified as payment stablecoins, even if they claim 1:1 backing. This signals a clear preference for asset-backed stablecoins, prioritizing stability and traditional financial principles over experimental, algorithm-driven models that have proven volatile in the past. The Act establishes a dual federal state regulatory framework. Federally approved entities can issue stablecoins under direct federal supervision, while state-regulated entities must comply with baseline federal standards. This aims to foster innovation while maintaining a consistent level of oversight across the nation. The Genius Act also extends U.S. regulatory jurisdiction to foreign entities that issue stablecoins to persons located in the United States. This means foreign stablecoin issuers will need to reassess their operational models and compliance infrastructure if they wish to offer products to U.S. residents, potentially creating a global standard by proxy. In the event of an insolvency of a stablecoin issuer, the Genius Act prioritizes stablecoin holders' claims over all other creditors. This provides an additional layer of consumer protection and instills confidence for users. In a separate but related development during Crypto Week in Congress, the Anti-CBDC Surveillance State Act also passed, preventing the Federal Reserve from issuing a retail central bank digital currency directly to Americans. This aligns with the administration's stance of promoting private sector innovation in digital assets rather than a government-controlled digital currency, a move that has garnered significant support from privacy advocates. While the Genius Act is now law, another significant bill, the Digital Asset Market Clarity Act, passed the House and is now awaiting Senate consideration. This bill aims to delineate when a cryptocurrency coin or token is a security or a commodity, and thus regulated by the SEC or CFTC respectively. Its passage would provide much needed clarity for the broader crypto market beyond stablecoins. The signing of the Genius Act is a seismic event for the US financial landscape. Let's break down its multifaceted impact. Now, the most immediate and significant impact is the immense boost in legitimacy and confidence it provides to the crypto industry, particularly stablecoins. Now, for years, traditional financial institutions and large corporations have been hesitant to fully embrace cryptocurrencies due to regulatory uncertainty and perceived risks. The Genius Act, with its stringent reserve requirements and clear regulatory framework, removes a major hurdle. Major US banks, payments platforms like Zelle, and even retail giants like Walmart and Amazon are reportedly in talks about issuing their own stablecoins. This signifies a massive influx of capital, technology, and user base from the traditional financial sector into the digital asset space. This isn't just about crypto. It's about the tokenization of the entire financial system. Now, we've already seen the public debut of spot Bitcoin exchange-traded funds, ETFs, in early 2024, attract substantial institutional and retail investment. The Genius Act further solidifies the regulatory environment, encouraging even more institutional players, pension funds, and wealth managers to allocate capital to digital assets. This increased demand will undoubtedly have a positive impact on the prices of major cryptocurrencies like Bitcoin and Ethereum. Bitcoin, which recently hit a record high of over $123,000, is poised for further growth, with some analysts predicting it could reach $150,000 by the end of 2025. Companies directly involved in the crypto ecosystem, such as cryptocurrency exchanges, blockchain technology providers, and companies developing stablecoin infrastructure, are likely to see significant increases in their stock valuations. Traditional financial institutions that embrace stablecoin issuance or integrate crypto services into their offerings could also benefit. This could lead to a re-rating of certain sectors and a reallocation of capital within the stock market. Now, Treasury Secretary Scott Bessent has explicitly stated that the Genius Act will help cement the US dollar as the global reserve currency for generations to come by on-chaining the dollar. By providing a clear and secure framework for dollar-backed stablecoins, the US is essentially digitizing its currency and ensuring its continued relevance in the rapidly evolving global financial landscape. The requirement for stablecoin issuers to hold reserves in high-quality liquid assets, including short-term US Treasury bills, will directly increase demand for US government debt. This could help Treasury yields stable or even lower, making it cheaper for the US government to borrow and potentially easing inflationary pressures. As other nations explore or launch their own CBDCs, the US is taking a different approach by fostering private sector innovation around a digitized dollar. This strategy aims to leverage the private market's agility and reach to maintain the dollar's global dominance, rather than relying solely on a government-issued digital currency. This has significant geopolitical implications, reinforcing US financial influence. The stringent reserve requirements, audits, and disclosure mandates are a significant win for consumer protection. They aim to reduce the risks associated with stablecoin volatility and issuer insolvency, making digital assets a safer proposition for everyday Americans. This increased trust is crucial for broader adoption. The enhanced AML and sanctions compliance measures will make it more difficult for illicit actors to use stablecoins for money laundering, sanctions evasion, or terrorist financing. This addresses a long-standing concern of regulators and law enforcement agencies, improving the overall integrity of the digital asset market. Now, while some within the crypto industry might initially view regulation as a burden, the overwhelming sentiment is that regulatory clarity is essential for long-term growth and mainstream adoption. By providing clear rules of the road, the Genius Act encourages responsible innovation and investment, allowing legitimate businesses to thrive without fear of sudden regulatory crackdowns. It's crucial to also acknowledge the criticisms and potential challenges associated with the Genius Act. That is, anti-corruption activists, including Transparency International, have raised concerns about potential loopholes, particularly regarding stablecoins issued by foreign companies like Tether. Critics argue that the bill may not adequately regulate these foreign-issued stablecoins, especially those traded on the secondary market outside of US jurisdiction. This could create avenues for money laundering and sanctions evasions, potentially undermining the Act's overall effectiveness in combating illicit finance. While the Genius Act focuses on stablecoins, some consumer advocates argue that the broader suite of crypto bills lacks sufficiently strong consumer protections, particularly concerning more volatile digital assets. Concerns have also been raised about the potential for weaker, less stringent rules for the crypto industry compared to the traditional financial sector, especially around insider trading and market manipulation. The potential for major tech giants and large banks to issue their own stablecoin raises questions about market concentration and fair competition. If companies like Walmart or Amazon issue stablecoins, it could potentially weaken competition among their vendors and give these corporations even greater control over consumer transactions. A controversial provision in the Genius Act bans members of Congress and their families from profiting off stablecoins, but notably excludes the president and his family. Given President Trump's family's reported significant stake in World Liberty Financial, a crypto firm that launched its own stablecoin, this exemption has drawn criticism regarding potential conflicts of interest. This aspect may lead to ongoing scrutiny and calls for further amendments. The US's move to regulate stablecoins has triggered a significant global response, igniting what some are calling a full-scale global digital arms race. No government wants to cede financial innovation or influence. As the world's largest economy lays down clear legal foundations for digital assets, other major financial centers in Europe, Asia, and beyond will be compelled to accelerate their own regulatory frameworks or risk being sidelined. We can expect a cascade of new crypto legislation and increased efforts to standardize international regulations. While the US is promoting private stablecoin innovation, many countries including France, Brazil, China, Australia, and India have already launched or are actively piloting central bank digital currencies. The US decision to ban a retail CBDC while empowering private stablecoins presents a distinct approach. This could lead to a global landscape with some nations embracing state-controlled digital currencies and others fostering private sector alternatives. The interplay between these two models will be a key dynamic in the coming years. Some emerging markets have expressed concerns about the potential influx of dollar-dominated stablecoins on their domestic markets. They will need to balance their policies on dollar-backed stablecoins with the development of stablecoins denominated in their own fiat currencies. The extraterritorial application of the Genius Act means that foreign stablecoin issuers operating in the US market will face increased scrutiny and compliance burdens. This could lead to greater international cooperation on regulatory enforcement and a more harmonized approach to combating illicit finance across borders. For investors, the Genius Act presents a landscape of both exciting opportunities and evolving risks. Companies involved in the issuance and infrastructure of compliant stablecoins stand to benefit immensely. This includes established financial institutions, fintech companies, and blockchain technology providers that can offer the necessary technical and regulatory solutions. With increased institutional adoption, the demand for secure and compliant digital asset custody solutions will surge. Cybersecurity firms specializing in blockchain security will also see heightened demand. The underlying blockchain technology that enables stablecoins and other digital assets will be a crucial area of investment. Companies providing scaling solutions, interoperability protocols, and decentralized finance platforms, while still subject to evolving regulation, could see significant growth. Now, investors should look at traditional stocks that are either directly engaging with crypto, example holding Bitcoin on their balance sheets offering crypto services, or are poised to benefit from the broader digital asset ecosystem. This could include payment processing companies, technology firms, and even some retail giants. Regulatory clarity typically unlocks venture capital investment. We can expect a fresh wave of funding for Web3 startups focused on compliant digital assets, blockchain applications, and decentralized technologies. While the Genius Act brings clarity, it doesn't eliminate all risks. Investors must continue to conduct thorough due diligence on stablecoin issuers, understanding their reserve attestations, compliance frameworks, and overall business models. The Tether loophole and other potential areas of concern warrant continued monitoring. As with any emerging market, diversification remains key. The crypto market is still volatile, and while regulation can bring stability, unforeseen challenges may arise. A long-term investment horizon focused on fundamental value and regulatory compliance will be crucial. President Trump's signing of the Genius Act is not merely a legislative formality, rather. It's a declaration that the United States is embracing digital assets and intends to lead the global financial revolution. This legislation sets a strong foundation for the mainstream adoption of stablecoins, paving the way for a more efficient, transparent, and secure digital financial system. The coming months and years will undoubtedly see an explosion of innovation, investment, and strategic partnerships between traditional finance and the crypto world. We will witness the tokenization of assets accelerate, cross-border payments become more seamless, and a new wave of financial products emerge. For the US economy, this could mean increased foreign investment, a strengthened dollar, and the creation of countless new jobs in the digital asset sector. For US stocks, it signals a significant growth opportunity for companies at the forefront of this digital transformation. However, it's also a time for vigilance, acknowledging the complexities of implementation, the potential for unintended consequences, and the ongoing need for robust consumer protection. This is a dynamic and exciting time for finance. The Genius Act is a testament to the growing influence of the crypto industry in Washington and a clear signal that digital assets are no longer a fringe phenomenon, but an integral part of our financial future. Stay tuned for more. Thank you for joining us today.